what we'll do is I'll just open up with Kate Keller. She's our president here at the Harvest Foundation to welcome everyone. And then I'll give a brief introduction of Michael Locker, and then we can go from there. And
Away
I'll
we go,
make
yeah.
sure, I'll make sure to put his contact information in the chat box.
Well, good afternoon, everybody. Thanks for participating in this call today, in this webinar. Michael has extensive background that India will let you know a little bit about what we're going to talk about today. And I think it's really critical information as we near the end of this tax season and moving into our next fiscal year. So I really hope you can all take lessons from what he has to say today. And I hope they're really helpful to your organizations as you do some of your planning. So I'll turn it back over to India.
Okay. So I'm very excited to introduce Michael Locker. Michael is a graduate of Virginia Commonwealth University and has over 30 years of public accounting experience. His practice focuses solely on assisting businesses all over Virginia with federal, state, and local incentive programs, along with their accompanying qualification and compliance requirements. Over the course of his career, Mike has built very strong relationships as a trusted advisor to businesses, state and local economic development agencies, commercial lenders, real estate brokers, and other professionals. His primary role consists of assisting businesses in identifying and considering the merits of various incentive programs, quantifying potential financial benefits, interacting with other outside advisors and government agencies, and preparing documentation packages to qualification. He is a frequent public speaker on incentives topics for business groups and is often called on to assist state and local agencies as updates to legislation and regulations are contemplated or enacted. We are very excited, as I said, to have Michael here to discuss tax benefits for donors in 2020. Just a few Zoom housekeeping rules. We just ask that everyone mute themselves. Also, please type all questions in the chat box, and Michael will respond as questions are asked, and I'll be sure to let Michael know when we have questions in the chat box. Also, I will be sure to put Michael's contact information in the chat box. And also, you should have received an attachment with information on what will be covered today. I can post that as well. So Michael, it's all yours. Take it away.
Okay, and you're going to post the outline up?
Sure, I can put that up, yes.
Yes, please. Hey, well, good afternoon, everybody. And thanks for the introduction, India. It's kind of funny. I've been a CPA for, oh my goodness, like she said, over 30 years. But a long time ago, a light bulb went on that there was a tremendous need for someone to get, at the time, my boss told me he needed to get a mile deep and an inch wide in the area of tax incentives and tax advantages. And so for the last 30 years, I've not done any of the things that most typical accountants do. I only help businesses with tax incentives, cash grants, historic tax credits, you name it. And so as I've gone through and around the state, rather than serve on individual boards, which I have in the past and been treasurer and president of different organizations, I've chosen to do things like we're doing today. And the reason I do it is because I found that there's a large need for education on things that will help not-for-profits work better. And so probably my initial exposure to it came in the form of, and we'll talk about it a little bit at the end, what most of you all, if you've been involved in it, know as NAP credits. And Virginia NAP credits, or Neighborhood Assistance Program credits, we got involved in it 1984, 85, and then a little bit after that. And at the time, believe it or not, nobody really knew about it. And we did a lot of presentations with the United Way, and then it exploded. So like it's today, it's very much overused. But the same thing is true for the topics we're going to talk about today. And again, a light bulb went on for me as we get close to the end of the year, because 2020, with a combination of some tax law changes and some special things, 2020 presents both a tremendous challenge for you all in the form of fundraising and just dealing with everything like we're dealing with this call today. And I think in the very, very short term, there may be an opportunity for some organizations to do something very special. And so as I was talking to someone right before we signed on, the offer that I'll make you today is that if any of your organizations or your board of directors or your finance committees would like to have a similar conversation as we're going to have right now, or on anything in particular about what we're going to talk about right now in the next 2 to 3 weeks, you cannot impose on me at all. I'm happy to do it because the fuse per se is burning now. And so you've got, pretty much you got 40 days or so to make something really good happen. So the first opportunity that I think, well, before we even start that, at the top of my outline, you'll see both my telephone number and my email address. And so you're welcome to email me with questions or comments or requests or text me, whatever you like. I also have a very important note there, and that is that I'll read it verbatim. As with any tax law changes, make sure that donors check with their tax advisors to confirm how and to what extent any of the things we're going to talk about today might apply to them. Tax is a funny business, and it's not one size fits all at all. So there will be occasions where things that we talk about today may, in one light, be just dramatically good, and another light, it may be dull as dishwater. So you want to make sure to that individual or that company that we actually make sure that everything works as we think it's going to. The very first one we'll talk about is something that came in with the CARES Act, and the CARES Act is the Coronavirus Relief Bill. And so on the CARES Act, there came in a special one time through the end of December 2020, an opportunity for those of us who do not itemize deductions. And so without getting into too much tax, lingo and mumbo jumbo, as all of us file our income tax returns, the first page of your tax return pretty much is, where did my income come from? W-2s and pensions and Social Security taxes and various other items. And then the next step down is you start to talk about, what things can you deduct away from that? Well, you'll finally wind your way down to where you either make a choice between taking the standard deduction, which most of us, 90% of Americans now do, or whether you will itemize deductions. And had this conversation happened 3 years ago, dramatically more of us would have itemized than we do now. So this particular facet of the CARES Act allows those of us who do not itemize deductions to still take advantage of a $300, not a tremendous amount of money, a $300 deduction, whether you itemize or not. Now, I have seen a number of organizations, there's a lot of confusion across the country that what that amount is. Should it be $300 or should it be $600? A lot of people say 300. A lot of people say 600, 300 if married people are filing jointly. But I can tell you unequivocally, it's 300. And I actually have the draft IRS forms and a bunch of very authoritative people. Now, my hope is, we'll see what happens. My hope is that so much has gotten out across the country and so many people have been told that it is $600, $300 a piece for people filing jointly. My hope is maybe the IRS or the Congress or the president or somebody will make a special exception and change it to 600. But I can tell you for sure, right now, if you get into the law and get into the IRS authoritative documents, it is $300 per tax return. So if you're single filing by yourself, it's a maximum $300. If you're married filing jointly, it's $300. If it's married filing separately or head of household, it's $300. So a lot of people would like for that to have been much, much more than that. But when it came through with the bill, it was there. That was the amount that was decided upon. And if you look at literature, it's referred to as an above the line deduction. So above the line, a line means you're actually above the line is all the stuff that is before you take your itemized deduction. So again, the long story short is, if you do not itemize deductions and you want to make a contribution to somebody, you get a $300 tax deduction, whether you itemize or not. People will ask me, well, what's that worth to me? And I would say for most people, if you just kind of took a federal and state percentage rate of taxes that they would ordinarily pay, it's probably somewhere in the neighborhood of 15 to 25%. So if it's 15%, then it saves you $45 of taxes to do this deduction. If you're in a higher bracket, a 30% altogether, you're going to be saving a lot more. So you're going to be saving twice that 90. So you're not going to get rich off of this donation, but it's something that's right there. And for those of us that are in a position where you might be able to either do some sort of an email blast or some sort of a mass marketing appeal here in the last 60 days of the year or 40 days in a year, that's the takeaway in this section, is that that those of us that don't itemize, you still get to take a charitable contribution deduction, but it won't be more than $300. But if you did the math, and said, if we could get 100 people or 200 people via a blast email or some sort of a mass appeal, and the donation is made in cash and it's made to a public charity, it can't go to a private foundation, or it can't go directly to a donor advised fund, then you just do that math and you say 100 times 300 is $30,000. You do 200 times 300, that's $60,000. That's a tremendously nice cash infusion at the end of the year. Most people that have pulled back some on donations because they don't itemize anymore and they can't get a tax benefit, as I've got it in the outline here, in truth, you really are getting a benefit because the standard deduction doubled. It now is $24,200 for married people filing jointly. So those of us that are getting a standard deduction like that, that's probably much more than we would have gotten otherwise. It's certainly much more than we would have gotten when we weren't itemizing anyway. So this particular donation deduction is a very good opportunity. I think of it if an email or mass appeal type blast or something in public, if there's some sort of an event or some sort of a Zoom call like we're having now, to generate that. It will take longer. The second one though, is I think where the home run could possibly be for some of the organizations. The second part of my outline is headed greatly increased deductibility for individual donors who do itemized deductions. And so if you think in terms of who that might be, it's most likely going to be someone who is making pretty good money and they have significant state and local taxes. They can deduct as much as $10,000 of that. They also can deduct their home mortgage interest. So if they have a big new home or a big home with a big mortgage, they very likely will have a lot of mortgage interest out there. So that person is, if you could target that person, or if you know of them on the list of your typical donors, here's where the opportunity is. As I mentioned at the very beginning, something called above the line stuff. Well, that's where you record your income and all those things. Below the line is where you take into consideration some certain deductions. It's kind of a half step, and you get to a number that people refer to as AGI. And AGI stands for adjusted gross income. And that's a key number on a tax return for a lot of people, especially a lot of people that make a lot of money. And the significance of it is that there are a variety of things that you can or can't do depending upon how much your adjusted gross income is. And so in the past couple of years and even up to now, for charitable contribution deductions, prior to now, that number could have ranged from, you'd have a maximum deductible amount of somewhere between about 20% up to this year at 60%, but it was before that was 50%. So if you're donating cash, or you're donating property, if you're donating stock, if you're doing a variety of things, depending upon what you were donating, you'd be limited in how much you could donate as a percentage of that number called adjusted gross income. And as I also mentioned before, is once you take either that standard deduction or your itemized deductions, the next step now is called taxable income. And that's where you'll either go back into the tax charts, or a computer will do it, and it'll compute the tax you owe. Here's where the opportunity is this time around. Special, one time, never done before. There's an opportunity now that if someone makes a contribution, it's got to be cash, it can't be other property, and it has to be made directly to a public charity. So it's got to be a 501c3 public charity, which most organizations are. Some aren't, but most are. For the rest of this year, if that check or that payment or that donation is made in calendar year 2020, they literally can write a check of as much as 100% of adjusted gross income. And so what that means is, in a lot of cases, a married person filing jointly or a single person, whoever it might be, they could literally zero out their federal and state tax liability, period. So if they have gone through this year so far and have had withholdings on their W-2 and paychecks, if they made quarterly tax estimates in anticipation of what their tax is going to be, instead of writing more checks to the IRS or to the Commonwealth of Virginia, instead of doing that, they wrote a check to one of your charities. So let's just take an example. Let's say somebody makes their adjusted gross income is $400,000. Well, make it $500,000. For most of them, they're kind of kind of a blended effective tax rate is probably going to be about 30%. And so what that means is you take, this is what your tax is, this is what your tax bracket is, times a number. If you can do something to erase that, that's what you save. And so in their case, let's just say it is 30%. So your taxable income is $500,000. 30% of $500,000 is $150,000. So what that party could do is they could literally write a check for $150,000 or to a couple of different organizations that add up to $150,000. And in essence, what happens is all of the withholding taxes and all of the estimated tax payments they put in during this year would be refunded to them. And your organization would be the beneficiary of getting somewhere up to $150,000 as a donation deduction. And so in your case, this is a monstrous opportunity, or potentially a monstrous opportunity, to be able to engineer or generate a significant tax or significant donation here at the end of the year. So I'm going to say it again, because a lot of times when you say stuff like that, especially to non-tax folks, it's hard to decipher that. But the long story short, not in all cases and not necessarily completely, but in a lot of cases, there will be people that are potential supporters of yours, and they have to be individuals that can write a check this time around. It's got to be a cash donation. They could conceivably erase whatever their federal and state tax liabilities are. And the reason the state comes along with this is that when you prepare your Virginia state income tax return, the starting point for Virginia state income tax is federal adjusted gross income. So if we had that same number that we were talking about earlier, and we had a $500,000 federal taxable adjusted gross income, it's the same for state, and that's where you start. Then you drop down and take some other deductions and add back some things, but you do not add back charitable contributions. And you get to the state's number of taxable income and then compute your tax. So it is that significant. Now, with this particular tool, if I were you all, I would take my outline back to the key board members and or officers and or supporters of the organization and kind of sit down and talk about it a little bit and think in terms of, I wonder who would be a candidate that we know pays big time federal and state taxes, or suspect based upon their appearance of being successful and having a lot of money, and so likely having to pay a big tax bill, and think this through with them, because there could be an opportunity. And I've actually sat in meetings and been taken to prospective donors or targeted donors, or been on calls with targeted donors to explain various tax things. And I've been on those calls when it was explained. And here's how the conversation sometimes goes. You go through all this, and then that person says, so what you're telling me is that if I write you a check for this amount tomorrow, I can literally erase my taxes, and I'll have my withholding taxes that I've already paid in and my estimated taxes I've already paid in, that will be refunded to me? And the answer is yes. And so when you have a proposition like that you want to convey to a targeted donor, you want to make sure that you put your very, very best foot forward. And that means that either someone like me, someone like their CPA, someone like a trusted advisor, banker, or someone like that has that conversation. Because, my experience in the past has been, you really only have about 30 seconds or a minute to make a pitch to a very busy, successful person who typically doesn't like details, you've got about 30 or 60 seconds to make an impression. And if you come across the least bit unassertive or not confident or not sure of your what you're saying, you lose them very quickly. So if you do go back after today and have that conversation and do have an idea for someone like that, please don't hesitate to reach out to me or to involve somebody's CPA or somebody's other trusted advisor to have this conversation with. Key thing is it's got to be in cash. So it can be a check, it can be an electronic transfer, it can be things like that. But it cannot be other non-cash type items, and it cannot go to donor advised funds. So that's a big thing I wanted to impress with you all, but that's very, very important to take away. Now, kind of one more thing that goes with that is most of the time, people that are in this position that can make this sort of a donation, typically they have been active contributors or philanthropists over the years, and they've donated cash, they've donated appreciated marketable securities, they donated non-cash things like buildings and property and various items like that. And those other items don't fall under this 100% thing, but ordinarily you would be reducing or counting, that would actually count against them if they wanted to give some other stuff. This year also has a tag along, especially big benefit to go with the 100% thing. And that is that you calculate all those other things first. And then whatever's left over, you can wipe out with this particular donation. So if you've got people that have businesses that have donated food or some different types of services or property or marketable securities, things like that, you know, this donating this piece won't negatively impact that. And to the extent those things are limited, you can carry them forward or use them up in future years. I did note a potential strategy or two, but I don't want to confuse you too much. So I'm going to go over this one, and then I'm going to let you all kind of take a breath. And if there are any questions, you're welcome to answer them. You know, as I told India, typically when I talk about tax stuff, you hardly ever get questions because it's hard sometimes to decipher how it might work for you or whether it makes sense, or people might think it's a silly question. So I'm going to give you a chance to ask some questions, but by the same token, email, telephone, any which way but loose after that's perfectly fine. The last one I'll mention in this section is that there could be some special opportunities to do things that might not occur to people. Now, if I say Roth IRA, have many people heard of that? I can only see a couple of faces. Okay, the Roth IRA is something that came into play several years ago. And it came into play because here's how it works. If I today have an IRA, so I contribute to an IRA, individual retirement account each year, and it's going to build up over time. And then when I retire, I want to be able to take money out. Well, in the past, and even still currently for a regular IRA, as you put money in, you don't pay tax on that money. As that money grows over 10, 15, 30 years, you don't pay tax on it as it grows. But as you take distributions out, once you're old enough and once you're retired and once you're in a position that you need that money, as you take it out, you're taxed on that money. A Roth IRA was put in a couple of years ago for a couple different reasons. One was revenue generating for the government, but the other was that what they were finding out is that people, even though they say they don't like to pay tax on stuff like they go, that's true, but they hate even worse to pay tax when they take it out in retirement and their income isn't what it was before. It's much more painful to pay the tax then. So the way a Roth IRA works is you pay income tax on the money as you put it in, and you pay income tax on the growth as it comes through. I'm sorry. You pay income tax on the money as you put it in, but when you take it out, you don't pay any income tax on the growth. So what happened was there was a period of time where people could make an IRA Roth conversion. And what that means is you stop today and say, hey, I put all this money in there and, you know, I think I'd like to go ahead and take that bitter pill and swallow it today. So what I'm going to do is I'm going to convert my regular IRA to a Roth IRA. And so what happens is, let's say you put in, I don't know, pick a number. Let's say you put in $2,500 a year for 20 years. That's $50,000. And then that $50,000 doubled. It got to $100,000 over that period of time. The way that the IRA, the Roth IRA works is you would take, in essence, you would take all that money out and you would pay tax on that total of $100,000. You'd pay tax on that. But you'd pay that tax today, but you would then put that money into the Roth. And for the next 15 or 20 years, any money you take out of that and any money it grows to, you never pay another penny of tax. And that's a big, big deal. But here's where it comes into play with this situation. Let's say you have a prospective donor that is that you get into this conversation with them, and you bring up, because you should, that there's a special advantage anyway for making contributions directly from an IRA to a public charity. But let's say that person says, you know, I've got a Roth IRA, or I'm thinking about doing a Roth IRA conversion. That person could literally do that conversion now and generate a bunch more income that ordinarily they'd have to pay tax on. But instead of doing that, they could literally make the contribution to one of your charities in the same amount and literally wipe out the tax that they would have had to pay on that Roth IRA conversion. And then that money that goes in, they will never pay tax on it again. So it's kind of the same idea in that somebody's facing a big tax burden for some reason, either just because of normal income and normal deductions, or they've made a Roth IRA conversion and they're going to have a big chunk of tax to deal with because of that. And in both cases, they could literally wipe out that tax by making a contribution to you all and then live happily ever after. Now, the truth is, they're going to have to part with that money. They're going to have to part with that money by either giving it to you or giving it to Uncle Sam and to Governor Northam. So if they're of a mind that if they had a choice, they got to pay it to somebody. If they've got a choice, they'd rather give it to you. Maybe you can get them to give it to you, and it'll be 100% legitimate and above board and a home run for everyone. So I'm going to pause just for a second, but does anybody have any questions or thoughts on what I've said so far?
Michael, there is a question from the chat from a little bit earlier. And it says, did you have to make the $300 donation after March 15th post-COVID?
I'd have to look to be sure, but my impression is all of calendar year 2020, but I'll confirm that and I'll let you know. Okay, the last section I have here, well, the next last session I have here is similar, but not nearly as powerful, but it's the same opportunity for a potential home run to some of the groups. And that is this category I've listed as greatly increased deductibility for corporate donors. And here's a situation with corporate donors. When I say corporate donors in tax lingo, I'm talking about what are called regular corporations or C corporations. Now, a lot of the people that, that I deal with that have businesses, they will have what are called S corporations, or they'll have LLCs. And the difference between those parties is that a regular C corporation pays its own income taxes. If I'm a president of an S corporation or I'm a managing member of a LLC, my entity does not pay its own income tax. Instead, the income flows out onto my personal return, and then I pay it personally. But this last category is referred to as what are called regular or C corporations. They have always had a limit on how much they can contribute to not-for-profit organizations and get a tax deduction for it. In the past, that number was 10% of their taxable income. So if you take a big company, a big C corporation or a medium-sized C corporation, they might have, pick a number, they might have $200,000 or $300,000 in profit. They may have $4 or $5 million in profit, just depending upon the size. But the ones I'd really be shooting for or targeting right now would be some of those that might have a big tax tab, that might have a $500,000, $1 million, $5 million in taxable income. And the reason is that most of those corporations, when they go through their planning to decide what they're going to donate to non-for-profits, typically it goes through some sort of a committee or a board or some sort of a link, within the organization where they decide who they're going to give money to and how much. And so they would have done their budgeting and planning earlier on this year, thinking that they were going to be limited to 10% of taxable income. Now, truth be told, many companies may not be in a profitable and have any taxable income this year at all, just because of the problem that everybody's run into with the COVID. I have some clients that are having record years this year because they just happen to be businesses that were their stuff is in high demand as opposed to depressed. But you have to be sensitive to that. But if you took a number, again, let's just take a number, $500,000. In the past, if that C corporation's net income, taxable income would have been $500,000, $500,000, they would have been limited to $50,000 as a tax deduction. Well, for 2020, for the rest of calendar year 2020, that rate has more than doubled. It is now 25%. So you could have a corporation that had budgeted and planned and decided to give $50,000, now able to actually to give 15% more. So now they're up to 25% of $50,000. I mean, of $500,000. So now they're up to, they could give $125,000. So the opportunity that could be there would be if you do have some links, to some significant size corporate entities, and I would count in that list if you have good contacts, even at some national organizations like Kroger, like Lowe's, like Home Depot, and other large organizations like that. And some of those are having record profitable years because people, their options dwindled way down. And with being isolated and quarantined, a lot of people have done tremendously more at-home projects. So there could be businesses in your communities that have done extremely well this year. And to the extent that they have, their limit now has jumped from 10% up to 25%. So for someone, like I said, that in the past would have had a $500,000 taxable income, they'd have been limited to $50,000. Well, that's changed drastically. For 2020 now, they're limited to $125,000. So you kind of frame that in, if you have a good contact with, or you have, a board member or officer that's affiliated with a bigger company. This is a conversation to have now, because I think it's going to be the entrepreneurial, not-for-profit organization that gets in there, and the early bird getting the worm opportunity that maybe has a special capital campaign or maybe has a special need that's been brought on by the economic conditions that you all have now. They might be willing to jump in quickly, where in the past they would not have been able to do that. Same thing is true, though. Same thing is true with this donation as with before. This only works for cash or cash equivalent contributions to public charities. It does not include non-cash donations or donations to other than 501c3 public charities. Okay, we got it? Okay, the last item I'm going to hit. I did look at some of the organizations on the attendee list, and I think you're already involved. But I wanted to make a quick pitch for the Virginia Neighborhood Assistance Program. I think a number of you all are already qualified for that, and to the extent that you already understand how it works, you're using all your credits up, good for you. If you want to have any conversations about maybe how best to use them, or maybe some avenues to go down to maybe to get some people to use your credits right now, and to combine it with some of this stuff here, that'd be a perfect time to do it. But for those that are not qualified, I just very quickly will give a quick description of this. If you're a 501c3 organization and you can document by statistics on an application that the close to the majority, at least 40 or 50% or so of the population that you serve fits some definitions for impoverished people and or people with educational disabilities, you can be allocated tax credits from the Virginia Department of Education or the Virginia Department of Social Services that you can exchange for donations of a lot of different things, cash, inventory, a bunch of different things. The appeal on the donor side is that they will get their federal and state tax deduction for that donation, as they always or would have done without this. But the appeal is that they can get a Virginia state income tax credit of as much as 65% of whatever they give. Now, truth be told, the pot that funds this program, people have to fight pretty hard for it. And there are a lot of organizations that can actually ask their donors to take less than 65%, and they will. So you can get as much as 65%, but to leverage those credits and make their allocation go further, sometime they can do that. Now, I did have a quick question here that asked about historic tax credits, and this is not the same as historic tax credits. This is purely, the Virginia Neighborhood Assistance Program is purely a program for not-for-profits to generate donations to further their causes. The historic tax credits is a for-profit tax credit program that awards tax credits based upon construction costs to renovate buildings that either have architectural or historic significance. So similar in some of the mechanics, but drastically different in their purpose and who they benefit. Okay. All right, and I did have a message that came in as far as to talk to a board, and I'll make this offer as I close if no one has any questions, because I want to make sure not to run over, is that I would be happy to either by telephone or however you like, if your board or your finance committee would like to kind of go through any of the stuff I've talked about and or the Neighborhood Assistance Tax Credit Program in detail, I'd be happy to do that. And if you want to do that over the next 2 weeks or so to make sure you get your conversations out before the end of the year, I don't see any reason why I wouldn't be able to do it. I'm pretty flexible by phone.
And Michael, we have another question really quickly. Can you recommend a website that we could direct our supporters to that gives a brief but accurate one-page overview of this information? In searching the IRS website, it seems to be listed on different pages, which isn't very user-friendly.
Yeah, unfortunately, if you go to the internet to try and Google tax topics, it's really hard, and it's typically focused in. But what I will tell you is that if you just say, is the CARES Act a 300-hour contribution? That will take you to a bunch of articles. There are a couple that I like a lot. And actually, I will tell you this, I've saved them as PDFs. If you want me to, if you'll give me the email, I think I've got email addresses. If you all want me to, I'd be happy just send you those 2 articles as a PDF. And one of them is from what is called the Kiplinger tax credit, the Kiplinger tax letter, which is an extremely authoritative document. All the accountants and all the CPAs watch that or read that. And then the other is literally the Journal of Accountancy, and that's the magazine of all the CPAs. So those are 2 very concise articles, and they'll get you a lot of this stuff. But unfortunately, it's tough to get everything boiled down, because then you start going off into the weeds on stuff that really is not of interest to you. But you're welcome to share my outline with anybody you like. And like I said, if you want me to talk to your board, I'm happy to do that. Indy's going to make sure I have everybody's email address. So I will, not today, it'll either be tomorrow or Thursday when I get back. But what I'll do is I'll send everybody both of those articles, and I'll probably just go ahead and put them in one PDF. Okie doke.
All right, are there any more questions? Okay, if not, thank you so much, Michael.
Okay.
We appreciate you, we appreciate your time, and thank you for everybody that joined us on this Zoom call. I will make sure that Michael has everybody's email addresses so that we can get those articles to everyone. And I hope that everybody continues to stay safe and healthy. So thank you for joining us today.
And let's make sure that everybody go out and try and hit a home run between now and the end of the year.
And also one more thing, there will be a survey sent out via email now. So be sure to complete that survey when you get a chance. Thank you.
Okay, we're all set. Thank you.